This is Barry Zalma speaking for Claim School Incorporated's blog, Zalma on Insurance. Today we're dealing with a fictionalized true crime story of the largest residential burglary of all time, where a fake burglary was created to cheat insurers. After 12 months trying to get insurance on over $3 million in diamond jewelry and a like amount of fine arts, a Taiwanese man who was a wanted criminal in his own country managed to convince two American insurers to agree to insure him against the risk of loss to the contents of his home. To obtain the insurance, he concealed from the American insurers that he was at all times that he purchased the insurance an alien a court had ordered deported, that in his home country he was a wanted criminal, that he had left his home country with over $60 million in checks unpaid, that every insurer at Lloyd's in London had refused to insure him, that all of his property was appraised for more than twice its actual retail replacement value, and that most of the antiques he had insured in reliance on an appraisal, attesting to over $3.5 million in value, were fakes and were totally valueless. His application gave the impression that he was a Beverly Hills, California investor with appropriate concerns for security. He also made it clear that he was willing to pay a high premium for the protection, a fact that should have raised the concern of the underwriters asked to accept the risk of loss of his property. Within 7 days of the delivery of his policy, a burglary was reported. A total of $7 million of specifically identified and scheduled personal property was reported stolen. He claimed an additional $2 million in unscheduled diamonds were stolen from their hiding place in one of his 50 suit coats hanging in his master bedroom closet. The burglars had no problem effecting the burglary because the insured was out of town, and the burglars were able to circumvent what the insurers had been told was a sophisticated central station burglar alarm system because it was merely a local gong-type alarm that had never been turned on. They defeated the promised Class E safe, one that supposedly required at least 30 minutes to drill out the lock, with a simple wood drill, since the actual safe was nothing more than a locking gun cabinet built into a closet. The insurers eventually refused to pay because they believed, after a thorough investigation, that the insured made material misrepresentations and concealed material facts in the purchase of the insurance. The insured retained a prestigious policyholder's bad faith lawyer to represent his interest. Because of the reputation of that lawyer for the insured and the fear of an extra-contractual judgment, the insurers, against the advice of 3 different defense firms, settled for more than $4 million of the $7 million claim. The insured's lawyer took a contingent fee of 50%, the insured's creditors took 20%, and the insured took what remained in cash, because his lawyer had to go all the way to the central bank to collect that much cash from the Federal Reserve. Because the IRS was slow, they were unable to assert their multi-million-dollar lien in time and received nothing. The insurers had spent hundreds of thousands of dollars defending the lawsuit brought by the insured. To save $3 million off the policy limit, they paid $4 million, which they did not owe. There was no question the insured committed fraud when he got the policy. There was little question that the burglary was also a fake. The burglars even threw some of their loot off a local pier where it could be discovered to make the world, and especially the insurers, believe it was a legitimate burglary. Even if the burglary was legitimate, there was clearly no coverage. A court with just a small amount of gumption would have declared the policy void. The insured had misrepresented that he had been refused insurance by several insurers and was canceled by another. He concealed many material facts. The promises he made when he bought the policy were false. The insurers believed the misrepresentations and facts concealed were sufficient to void the contract. After a trip to China to take an examination under oath of the insured sister, who was also a named insured and whose passport had been removed by the government, and 2 years of discovery, counsel for the insurers moved the court for summary judgment confirming rescission of the policy. The evidence available of multiple misrepresentations, the concealment of material facts, rescission was warranted, and counsel was confident the court would agree. The fact that the insured sister testified but then refused to allow for the fulfillment and completion of her examination under oath was also a ground to refuse coverage, and yet the day before the insurers' counsel were to appear for oral argument on their motion for summary judgment, the insurers and the insured's lawyers settled the suit without communicating with defense counsel and against the recommendations of their own lawyers. Common sense showed that an insured with a legitimately acquired $7 million valued policy would never settle for less than $7 million if he suffered a true loss. That he was willing to settle should have convinced the insurers the claim was fraudulent. Rather, the reluctance of the court to take a position, it had moved the oral argument 3 times, lack of action by the courts and the police agencies, and the lack of courage on the part of the insurers cost the insurers involved $4 million in settlement payments and many thousands in defense and investigation costs. To recover the money lost by paying the insured, the insurers could only pass the payment on to others, honest insureds, and to the reinsurers of the 2 policies. The insurers' fear of punitive damages that shadow every claim made in the states that recognize punitive damages for breach of the covenant of good faith seemed to be impossible for the insurers to overcome. To stop the criminal who brings a fraudulent claim, insurers must not be frustrated by the continual refusal of the authorities to prosecute insurance fraud. They should decide to recoup the monies paid to the perpetrators of fraud from the fraud perpetrators by judgment or order of restitution, rather than the honest insured whose premiums are raised to cover the payments made to the perpetrators. Some insurers believe they have no choice but to settle because the exposure to punitive damages in a bad faith suit, no matter how frivolous, is so great that a jury might believe the fraudster's arguments. Those insurers fail to realize that paying those who perpetrate fraud to eliminate the exposure to punitive damages, regardless of the cost of defense of bad faith lawsuits brought by fraud perpetrators, is not cost effective. Bad faith is a 2-way street. Even though insurers cannot sue for tort damages as a result of an insured's bad faith, they may sue to recover the damages they incur as a result of fraud. Criminal courts, when they convict insureds of fraud, should be encouraged to order the person convicted to make restitution of all investigative costs and legal expenses incurred by the insurer as a condition of probation, since for some reason courts are loath to put insurance fraudsters in jail. When an insurer makes a payment of $4 million for a claim it knows is fraudulent, even if it is through a $3 million saving over the policy limit, the insurer is issuing an engraved invitation to every con artist in the country to move in and try the same thing. The expense is not for just the obvious fraudulent claim that is paid. The major expense is all the other claims that are made with the knowledge that when pushed, the insurer will pay. Once an insurer gets a reputation for paying for fraudulent claims rather than fighting with all of its assets, those who perpetrate fraudulent claims will gather like vultures over a rotting carcass, ready to pick the bones clean. The reverse is also true. When an insurer makes it clear it will never pay a fraudulent claim, regardless of costs, those who earn their living by fraud will simply stay away and go after the insurers that are known to pay. It is time that prosecutors learn that the victim is not the giant insurance company, but each and every person who buys insurance. This video is adapted from my blog, Selma on Insurance, which is available free to anyone who clicks on the URL selma.com/blog. It is also available on Substack and on locals.com, and is available as videos on YouTube and rumble.com, all without cost. And you can subscribe to the YouTube, the Rumble, and the blog post, and you'll receive notice of every blog posting and access to at least 4,690 blog postings. And if you're interested in further detail about insurance, insurance fraud, insurance law, and insurance claims, please consider for a very small fee subscribing to my Substack publication. Thank you for your attention.